And I want to welcome all who have dialed in for this free of charge Roadmap to Recovery online educational webinar. I am Amy Bach, and I am the co-founder, executive director of United Policyholders. And I am joined today with two very special guest speakers. One of them is Mike Musson, who is a CPA, that's a certified public accountant. He's with a firm called Lincolnheimer. They're based in Santa Rosa. Mike has the unique experience of being a CPA who's been counseling hundreds of people, businesses, and homeowners that were affected by a 2017 wildfire in his region, but also he himself lost his family's home. So he has both personal experience and professional experience at grappling with some of the financial decisions and tax considerations that will come up in the aftermath of a catastrophic loss for anyone who owns property. We are also joined today by Eileen Freiberger. She is with Abacus Wealth Partners. She is a CFP, which is a certified financial planner. Eileen has a very unique, empathetic perspective to her profession of helping people make good financial decisions. Eileen has a real heart for people, and both of them have been doing volunteer work with United Policyholders over the last year. I'm very, very grateful to both of these people for taking time out of their work schedules to give an hour of free guidance to all who've tuned in. So the subjects we're going to be tackling today, tax and financial strategies for 2017-2018 wildfire impacted households. Now, when we started planning this event, we were initially going to have it only be aimed at people in Napa and Sonoma who had been affected by the 17 fires. But because we're providing our roadmap services, roadmap to recovery services in the area impacted by the Camp Fire around Paradise, California, and then the areas impacted by the Woolsey and Hill fires in Southern California, we decided that we would open this up to people outside of Sonoma and Napa. So although both Mike and Eileen are based in Sonoma and that region, income tax rules are federal and also state. And so the information that we are going to be talking about this evening has equal value whether you're in LA, Thousand Oaks, Malibu, Sonoma, Napa, or Redding, or Chico, or you've been wherever you've relocated from Paradise. So thank you again, Mike and Eileen. So just a little refresher on what is United Policyholders. We're a not-for-profit charity known as a 501c3. That is the provision of the federal tax code that gives us the ability to operate as a charity and not have to not have to pay our taxes ourselves, and also so that when people donate to us, those donations can be considered a charitable donation. That's largely how we get our work done, is from donations and grants. Our Roadmap to Recovery program aims to educate and support you in navigating a fair insurance settlement. Of course, because we're talking about taxes tonight, not directly insurance, you can see that the Roadmap to Recovery curriculum, the education support we provide, is really kind of full spectrum. So we start people off with education about how to read your insurance policy, how to understand what kind of coverage you have, and then how to know what your rights are, how the process is supposed to work, and some of those decisions. But then as we get down the road to say where we are now, where April 15th is around the bend, people are either they've been stressing out about their taxes or they're wanting to understand how their current status as a catastrophic loss survivor affects their tax filing. That's why we sometimes go outside of strictly talking about insurance to talk about financial decisions generally. So again, our aim here is to educate and support you. We fully realize we're not going to get to everyone's questions tonight. We're going to do our best to cover the basic ground, and then we will do our best. If your question doesn't get answered, then we have them, and if you've given us your email address, we will do our best to get people answers by email. And I want to again thank our volunteer speakers today for agreeing to help with that as well. As I said, we're funded by donations and grants. Our work gets done by volunteers who've recovered from prior disasters, as well as knowledgeable consumer-oriented professionals like Mike, like Eileen. You can learn more about our work at our website, uphelp.org. We run 3 programs. We're not going to go into a whole lot of detail here about the preparedness and advocacy, but I will say that that just last week, one of your fellow fire survivors from up in Sonoma was in Congress talking about some of the relief that wildfire survivors need vis-a-vis their taxes. And since we were formed, since United Policyholders was formed in 1991, people who've gotten educated through our program have also become active in going to their elected officials and asking for improvements. So we may hear from Mike about some sort of wish list items there might be, but for tonight, the focus is going to be on helping you make the decisions that you need to make for yourself, your family, your business going forward. For more tax guidance, in addition to what you're going to get here, on our website we have videos of previous live workshops. There were 2 of them where Mike Musson was our speaker. There's another one where another CPA spoke, and you can watch those. There's another CPA by the name of John Trapani, who you can see on our website. You'll see a lot of guidance that he's written, very technical. But again, if you're looking for answers that you don't get tonight, try looking on our website. Try following some of those links we give you. Coming up on Thursday of this week is a free webinar that the IRS is offering called Understanding Tax Relief for Disasters. It's 120 minutes of fun-packed info, I'm sure. But again, if you are a person who really wants to understand this subject and not just hand it right over to a CPA, then there's more than enough information for you. Generally speaking, we at United Policyholders feel like for most people, your best bet is to find a competent CPA to advise you on the basis of your individual situation, or a CFP, somebody like Eileen, who's got training, again, in how to make financial decisions that are in your best interest, not other people. And we can only do so much in a general forum like this. What really can help is sitting down one-on-one with a professional who's going to look at your paperwork. We've got a few events coming up I want to let you know about. We've got a workshop this Thursday for campfire survivors in Chico. We're going to be focusing on dwelling scopes of loss and getting your numbers nice and tight and strong. So when you go to your insurance company and say, this is what we feel we're entitled to for the rebuilding of our home, you've got a good package of documentation to back up your numbers. Then on Friday of this week, we have a free legal aid help clinic that we're doing where UP is bringing in some of our lawyer volunteers. Legal aid will be hosting, and you can go there and sit down one-on-one with a lawyer. And finally, we have another workshop coming up in Thousand Oaks this coming Saturday, and that'll be from 2 to 4. All this information you'll find on our website, uphelp.org. Here's a link, and that's our homepage. Then you can see we try to make it easy for you to go to the library that corresponds with your loss. So if you're a North Bay fire person, we have a library for you. If you're Woolsey, we have one for you. Lilac, Camp, etc. where we're curating guidance that's specific to your area. Just a little bit of fine print. We don't sell insurance or accept money from insurance companies, so we can keep a very straight, open mind and give you information that's in your best interest, not in the interest of somebody who's trying to sell you something. That's why we're a charity. We don't give legal advice. We're only giving general guidance, and we don't endorse or warrant the quality or services of any of our speakers or any of the sponsors we list. Obviously, we look for good people. We would not bring somebody to you if we didn't have confidence in their professionalism. So what I want to do is start by just hitting the common personal finance questions that our organization gets. People typically say, I want to collect every available dollar of my insurance. Am I better off replacing my home by rebuilding or buying? We're going to talk about that a little later. If I rebuild, what size home makes the most sense? How does this catastrophe impact my retirement, my budget, my college, future plans, money I set aside? Probably the most common question we get, and this goes right into your tax strategy and your financial planning, is, I'm underinsured. My dwelling was not insured for the actual amount it's going to cost me to replace it. That is a very common, probably at least 2/3 of the people that lose their homes in a disaster, particularly wildfires where everything is gone, find themselves underinsured. So what are their options? What are your options if you're underinsured for financing reconstruction? If you replace with a smaller, cheaper house, what happens to your property value? But more importantly, is there anything I can do with my taxes to get relief from my situation? Is there anything I can be thinking about vis-a-vis taxes and my income tax filings that's going to help me get back on my feet financially and in a rebuilt home and in reasonably healthy financial shape again? So, Mike, I want to turn it over to you to talk a little bit about disaster relief basics. Uh-oh. Mike, are you there?
I'm muted. Oh, now I'm not muted.
Sorry.
So anyways, just going through the slides, I'd just like to mention these slides are from a presentation we did a while back. So they're going to be a bit off base as far as, for instance, this first paragraph where the counties are mentioned. Obviously, there's a lot more counties now.
Right.
So just as a definitional thing, the reimbursements I mentioned at the second bullet point are not taxable. So reimbursements you're receiving from, for instance, here in Sonoma County, Redwood Credit Union created a fund and was handing out gift cards. Those proceeds are not taxable, period. Amy, you want to advance the slides?
Sure.
These are some other matters, and again, these slides are a bit dated, but they do have application even now. In all of these counties affected by the fires, there will be property tax assessments. Here in Sonoma County, after the 2017 fires in October, the Sonoma County was very proactive in reassessing properties after the burn. I thought they did a very good job reacting and making sure people weren't paying taxes they didn't know.
Okay. Let me take a step back here, Michael, and ask you a question. So for anybody who's tuned in tonight, okay, what is your general guidance on filing for a property tax reassessment for a wildfire survivor? Does everyone need to do that?
As of right now, and again, in my anecdotal experience, you don't need to file anything because, again, the county was very proactive and personally, and speaking from my client's perspective, for instance, reasonable, at least reasonable enough.
Okay. So no matter where you live, if you have gotten a property tax bill since your home was destroyed, what should you do?
It just so happened that the property tax was circling back after the October fires, right? We were getting those notices and those payments were due in November. Sonoma County told us not to pay them. because they were going to reassess the properties, and those new assessments came out in the winter, essentially, after the turn. So it's going to depend on the county that you're in and the timing of your fire.
Gotcha.
But Sonoma County did not assess penalties, until they reassessed the properties.
Okay. So focusing back where we were on personal casualty losses, the next point here, this seems to be, there's a lot of areas where people are very confused. And I think one of them is, okay, so what, should I take a personal casualty loss? Can I? When? Can you just sort of give us a general overview of that?
I'll try. So, and this is going to be difficult. And so I'm going to preface this with the fact that I understand that anybody that's lost their home in the fire has suffered a loss. There's no discounting that you can't say it any other way. However, that doesn't necessarily mean you've had a tax loss. And so I'll do my best to explain that.
Okay. So
if you bought your house, for instance, in the 80s, and I'm just going to throw a number out, and let's say you bought it for $250,000. Likely as not, your insurance coverage gave you more than $250,000 for that building after the fire. And so if you consider that for tax purposes, the insurance proceeds and the fire essentially acted like the sale of your house, your sale of your principal residence, you can maybe see that you don't have a loss. And so I saw many people, right, that bought property, let's say for $500,000, and they had coverage of $500,000 or more. And so they did not suffer a loss. They actually, most people have a small and sometimes large gain, depending on what property you're talking about.
Let me stop you for a second, because this is such an important point. So there's sort of like two different languages we're speaking, right? There's a loss,
I like that.
Right?
Yep.
There's a loss from a personal standpoint. There's no question, right? Everything's ouch, right? A horrible loss. But
no questions.
From a financial standpoint, when we talk about a loss in the context of taxes, that's where I think people get confused. They say, well, of course I had a loss. Can I claim that on my income taxes? But right. The problem is that that what you were saying, when the fire takes your house, which sometimes gets referred to in the law as involuntary conversion, it's like you sold your house at that time, right? And the amount
That's
you
correct.
got for it was what your insurance company gave you, correct?
That's correct.
And
there's another concept in there. I don't want to interrupt you, but there's another concept in there that's really important, and that's basis. And you can't lose more than you've actually invested in your property. And so people, when we're dealing with insurance, your comment about the other language, when
right.
We're talking about insurance, we're so often talking about replacement or fair market value. And these concepts really, in a way, don't have much to do with the taxes. They can, but they usually aren't as applicable as the cost basis. So for instance, if you buy $10,000 worth of Intel stock, even though it's worth $50,000, you can't lose more than $10,000, your investment.
Okay, so let's get back to the basis, because I think we can assume that almost everyone who's tuned in to listen to this lives in California, or their property is in California. So we know that in a lot of areas in the state, the sales price of the house could be hugely different from what the purchase price was, right? So, like, for example, most people bought their house for much less than it's worth now. Is that why this is so confusing to fire survivors?
I believe so. And you can even make the argument that personal property is the same, it almost has the same result. However, I think you mentioned just a little bit earlier, each one of these situations is facts and circumstances. It's very, very difficult to generalize until you see all the numbers.
Okay.
But personally, I have yet to see a personal property loss.
Meaning what? Meaning somebody who came out worse from the fire on paper?
Correct. From a tax standpoint, I have yet to see a personal casualty loss.
And that is because the amount that people collected from their insurance is at least as much as the cost basis for those items. Is that right?
Correct. Correct. That is well spoken.
Okay,
if I was gonna, let's say we were just gonna say, how could I see a loss? I could see somebody bought their house in 2007 way overpriced, right at the peak of the market. Maybe they have a problem, but most everybody else, I almost can't imagine it. Again, because it's California real estate.
Okay, so that is why. Okay, so now I want to take one step back, and Eileen, if you have anything you want to add, please just jump right in.
I'm seeing some of the comments, so I would like to comment, even though Mike mentioned a stock, basis is the same whether we're talking a stock sale or a home sale. So Mike is giving the little bit of a foundation in order to help people understand where the tax ramifications for the sales, for the involuntary sale, come into play. So we're just kind of building from here. And we'd like to just, I'm seeing some of the notes. We'd like to ask everyone just to bear with us as we build a foundation. But this is important because there's a lot going on, and understanding a little bit of this information gives us the foundation for the conversation.
Right, and this is important because this is now the fourth one of a similar educational offering that we've made, and I can feel after every one, people are still confused. And so I think it's important to obviously, we say, if you can sit down with a professional one-on-one, that's the ideal. But we're here to try to give general guidance to people. People have an instinct to worry about, am I blowing a deadline? Is there something I'm supposed to be doing? So can we just take a minute and say that if you still don't understand this, that's okay, right? Because you can go back and amend prior returns if you're a disaster survivor, correct?
I would agree with that, although I would say that for instance, again, anecdotally with the October 17 fires, if you had a gain and didn't report it, you have made an election to defer that gain. And so, but again, my advice, and to echo your comments, my advice at that time would have been not to report it, because you didn't really know what you wanted to do. You didn't know if you had enough money to rebuild or replace and all those things, and it was fine. So I just wanted to mention that you have done something, but it's not the end of the world.
Okay.
And patience is okay. It's all right to wait.
Okay, that I appreciate, because I think a lot, since we have some people on this call that on the webinar who lost their home in 2017, some people who lost their home in 2018, the people who lost their home in 17 have already gone through one filing. If you didn't get good advice last year, don't stress too much. You still have another chance this year.
I agree, and I've talked to a number of people, that, let's say, didn't talk to anybody and went ahead and filed their returns and things. It's not the end of the world. You're still working things out. Anything that will or will not happen can be remedied.
I really appreciate that. I know people who've dialed in will appreciate that too. Mm-hmm. Okay, should we talk a little bit about individual income tax matters? People ask a lot about, okay, I got ALE money from my insurance company. Is that taxable?
Because this is a presidentially declared disaster, actually I'll back up just a little bit. If you go and talk to a tax preparer that maybe doesn't have experience with this particular situation, they're going to fall back on the normal rules under involuntary conversion, and they may give you the wrong advice. So if you do go talk to somebody, make sure and emphasize that this is a presidentially declared disaster, because it gets special treatment. That treatment includes, of your insurance proceeds, your living expenses and your personal property settlement are not taxable, period. You don't even need to think about it.
Okay. What is taxable?
What is taxable is potentially that stuff related to your building and any scheduled personal property. And not many people have scheduled personal property. That would be something like insuring art or like a piece of, antique jewelry or something like that. I have yet to see something like that too. But the proceeds related to the building, which would include, this language better than me, but coverage A, so your base coverage, your extended coverage, your supplemental structures, your landscaping, trees and shrubs, code upgrade, all those things would be balled up. In other words, pretty much everything other than ALE and personal property is going to get balled up and treated as proceeds as if you'd sold your home.
That's the tricky part here. So
Yeah.
Everything that you will have gotten from your insurance company, obviously many people are still in the middle of an open claim, right? But everything by the end of their claim that at some point needs to get factored in with their tax return?
Their building proceeds, all those things I just talked about, need to be considered in filing their return in the year of the fire as well as possibly in subsequent years.
Okay.
So I'm going to go back and talk to basis really quick. Again, when we're talking about the basis in your home, consider not only the purchase price, but any improvements you may have made. If you poured a concrete patio, that kind of thing. All those things add up to how much basis you have in your property. So for instance, if you had $550,000 worth of insurance proceeds on your building only, and you'd bought the house for $350,000 and put $50,000 of improvements in, you'd have a $150,000 gain.
And how is that significant?
All I'm saying is don't forget to add improvements into your basis.
Okay. Eileen, can you translate, why is it so important that your basis be accurate to include what you put into the house?
I appreciate it. And just to help answer some of this, because it's a lot of technical information, but ultimately major decisions are going to be made about either selling because of the involuntary sale of the fire, renting instead of rebuilding, buying something new. And the reason why this is so important is we get in the habit of saying, well, I purchased it, as Mike said earlier, for $250,000 or $300,000, but the proceeds later that someone received might have been significantly higher. So we do want to take the time to remind everybody, your basis will include the purchase price plus the improvements. And then with those figures, you're using that information to now decide, is there a tax ramification? And I know Mike
is there a gain? Exactly.
Right. And I know Mike has a slide here that might be easier if we had some real numbers that we can talk to it specifically.
Okay, let me get to that.
Okay, because I think, again, it's a lot of information. So let's talk to a specific slide with actual numbers. And remember, you're using this because we, out here for what we've seen, and our company has offices in LA, we're very, very familiar. A lot is going on. And we want people to just take a breath and realize major decisions are about to be made. If you are concerned about the tax ramifications, first use a slide like this to actually recognize if there will be a tax hit. Because those decisions about rebuilding or buying something new will be very unique to those of us in California as far as our options. And I'm going to turn it back
Carolyn,
to try to help
hey,
build
Carolyn,
on.
Carolyn, can I ask you a question?
Here, I'll unmute her. Hold on.
Okay.
Hold on.
Hi, Carolyn.
Yes, hello.
Carolyn, sorry. Hey, I wanted to ask you, so, proceeds are proceeds. Really, the only leverage against taxable gain here, potential taxable gain, sorry, is our basis, wouldn't you say? And so the more basis we have, the less gain we'll have. Is that fair to say?
Okay. Sorry.
I think you meant, were you asking Eileen?
Oh, sorry. I was asking Eileen. I apologize.
That's all right.
Yeah.
That's okay.
So could she hear me?
I'm sorry, Mike. I missed part of that. Repeat it.
Sorry, I just wanted to say that basis is really the only leverage we have. Does that make sense? Because, sales price is going to be sales price, quote unquote, right? Whatever we get for insurance, we're going to get. But we can minimize or mitigate our gain by providing as much basis as we possibly can find.
Absolutely. And that's why, as we try to help clients and folks right now make these decisions, helping everyone recognize the numbers are important, that at least they understand where this data is coming from. Because a decision to rebuild and continue with the basis, a decision to take the proceeds and rent elsewhere, or a decision to take proceeds and buy elsewhere, all come back to understanding what else might happen out of pocket. And both you and I are saying, in many cases, there may not be an out-of-pocket tax hit. And that's why we're asking everybody to just try to be comfortable understanding this particular segment, because we are talking taxes and the ramifications.
Okay, so can we're all on the same slide here, personal residence casualty loss example. Yes?
Yes.
Okay, you want to walk us through this? This is the example that we're
right. So so this is kind of along the lines of what we've been talking about. We have bought a house for $400,000. This is actually an old set of slides, by the way. But what we want to understand is that again, we've got insurance proceeds that are going to may result in a gain, again, kind of because it's California. So this slide here just tries to go towards calculating what might be a casualty loss. Consider this when you're thinking about gain versus loss. You didn't use the land. And so you didn't lose the land. So if you need to calculate a loss, you need to figure out of your original purchase price, what basis includes the land. And if you had your property tax statement or something from proximate to the purchase, you'd have an idea of what the basis in the land was. But this goes through a calculation of a potential casualty loss calc.
Okay, so this example is the home was bought for $400,000. Then you deduct the 100 for land in terms of and you get to 300. They got
for the building, correct?
They got. I'm sorry.
Yeah, so the 300,000 represents the building
Cost basis, and then they got 200,000 in insurance. They were underinsured. That's how much they got. Then they got some money from FEMA, and then that left a $50,000 loss. Right now,
yep.
There. I don't tell me what happens next.
Well, actually, when it was later changed, you actually don't do this $10,100 adjustment. It would be a $50,000 casualty at this point.
I'll tell you what.
The law was changed
because I don't want to go off of old slides. Why don't you guys? I don't want to work off of a bad slide.
What, Amy, the concept is still legit. You know what I mean? Because it really does show you have $300,000 basis in your house, and you had $250,000 of quote unquote proceeds. So you have a $50,000 loss. And again, take it to your tax preparer if you indeed think you have a loss.
Okay, so let's just go back to kind of basics, and then we'll skip back to the early part of the slide. We're talking about the basis, the cost basis, right? You always would want to put think cost before the word basis of the property after the casualty loss, right? Decreased by insurance and or other reimbursements, decreased by casualty loss taken. That's if they actually did that math that we just showed resulted in a loss, and then increased by amounts that they spent to restore. Is that correct still?
Yeah, that's still all good.
Okay, all right, let me see if I can get back to where we were. All right, so let's go back to what is a casualty loss and just go through that.
because it's presidentially declared disaster, we know that it's a casualty. This definition really revolves around casualties in general, but I would make one comment, beyond what you can read, and that is the damage must be permanent. And so, for instance, if you have a rural property with trees on it and those trees burn, that may not qualify as a casualty under the IRS rules because they say that trees grow back. So it has to be a permanent damage in order for you to qualify for a casualty loss.
Okay.
So again, I don't have much more to say on this other than what you can read. On a casualty loss, one point I would make is that you will not get a casualty loss without filing an insurance claim.
Okay. So let's take a step back here. I would imagine that a lot of the clients that you have been talking to were underinsured. Is that true?
Yes, I would say that. Yes.
Okay. So can you talk to us then from, a high, 60,000 feet, what is the general guidance you give them when they walk in your office and say, I was very underinsured. What kind of tax strategy can I implement here to lessen this pain? Can you talk to us about that?
Yeah, I'm going to kind of flip this on its head, and Eileen, you step in here if you want, but I'm going to say don't be afraid to pay taxes. And so I'll give you an example. Again, I'm just making things up. If you'd bought a house for $250,000 and just got insurance proceeds of $1 million, you actually haven't lost, in a sense. Now, I know, again, I'm acknowledging that we've lost everything. I don't have pictures of my kid, that kind of stuff, right? But from a tax standpoint, you haven't lost. You actually sold your house for a $750,000 gain. So don't be afraid of the taxes. I know it's a little bit of, it's not easy to hear, and this isn't a political conversation either.
I think that's a very important point, and I do want to hear, Eileen's thoughts about it. And the reason I think it's an important point is that I think, those two languages that we were talking about, loss language of, oh my God, I've lost, how could you tell me I haven't had a loss? This is the worst thing that's ever happened, to a lot of people who go through it. But what you're saying is that you counsel people to see that as one kind of loss, but then understand how the IRS sees it and know that if you were paying taxes before the loss, that this is not this tragedy doesn't mean you're not going to have to keep paying taxes. Fair enough?
Right. And
That's fair.
I will chime in here. So I'm going to put on my financial planner hat. And as I said, none of us are here saying there was not a personal loss, and all the empathy in the world goes out to every single person dialing in. But if we build on on Mike's conversation, the involuntary loss, you basically are receiving proceeds of $1 million. If the basis, someone's purchase price, and I'm building on what Mike had said, the purchase price was $250,000, and let's just say over the years someone did, add additions or did some major remodeling. Maybe the actual cost into the house might have been an extra $200,000. So now, if it is considered a sale, you're actually able to not have to pay an extra $250,000 exemption if you're single, or $500,000 if you're married. So there may not be a tax ramification, and the bottom line is the person is now sitting potentially with proceeds of, let's just say, $1 million. Some of it may have to go to a mortgage. This is why big picture financial planning and each person's situation is very different. So what's really left over when it's done? It could be that someone truly still has cash of $600,000, $700,000, $800,000. And our role as a financial planner is to help decide, well, what's the current rental prices? Does it make more sense to use those proceeds in rent? If you can purchase something elsewhere, which in the state of California, you can use these monies to buy elsewhere and carry over the existing basis. So potentially maybe you're buying something similar pricing, maybe it was less expensive. But we have to really stop a moment and put on that hat to say, this is a sad opportunity, but it does give someone the chance to either rebuild on the land, buy elsewhere, or use the proceeds to rent. And that's where a one-on-one conversation and having the background of this conversation in hand allows you to work with your current CPA and any financial planner that's doing this type of planning to help you and assist you on these conversations. And Mike and I are both trying to lay that foundation so people are more comfortable in what they're asking when they're asking for help.
Okay. Well, I really appreciate that. We have some questions that I'm going to start to ask you guys, since the slides are maybe not as helpful as we would like them to be, and that I take responsibility for. But I think that, again, you know, a lot of what United Policyholders tries to do is to give people facts and information so they can make decisions in a thoughtful, calm way. And so, for example, this question about, do I replace my home by buying a new one? This is right in, you know, Eileen's sweet spot. But of course, the tax considerations are going to be part of making that decision. So, okay, but on our website, in our library, we have a lot more technical information. You can go, you know, to our regular claim help library, and you can use the search box, and you can type in buy or rebuild, and you'll get a whole section of guidance on what are some of the factors to consider in that scenario. Okay, so let's go to some of the questions. What do you do if you had a lump sum settlement from your insurance company and they did not break down ALE, personal property, or the dwelling? They just sent one big lump check.
Is that to me?
Yeah, sorry.
So here's what I would do is I would go back into the policy and try and tear it down. Further, you could ask the insurance company for details. I know that might not be that comfortable, but personal property was likely a percentage of something. And without them telling you something, I would go back to the policy language and try to establish what it is.
Okay, and for most people, your contents limits are going to be about 70% of your dwelling. That's how the formula is, but not all. Okay, Eileen, anything to add there? If you got a lump sum and it's not broken out, do you have any thoughts on what a person can do in that situation just to make sure they're safe?
I'm agreeing with Mike. It's important to know the differences of where those proceeds came from. And again, knowing that if you are using it to buy something, your original basis will follow. So I see one of the questions that had come up was asking, but aren't I paying taxes? And again, very potentially you're not. So we do need to break down, you know, for what portion were those funds coming from?
Okay.
Right. I think, Eileen, if I could step in just for a sec, you made the point earlier, we're trying to build a foundation. We haven't even got to the point where we've decided whether it's taxable or not. Do you know what I mean? We need to figure out if there's a gain first. Mm-hmm. Right. For instance, let's say there was an excludable gain because it was your principal residence. You know, you'd mentioned 2 out of the last 5 years. Maybe they're married. They get a $500,000 exclusion. You may not have a gain at all. You may not even have to replace or rebuild. But we need to figure that out first.
So are we saying that the very first thing that a wildfire survivor needs to do, and they can't obviously do it right away because they don't know how much money they're going to be getting from their insurance proceeds, but they do need to at some point calculate what kind of a loss, financial loss, in speaking money language, not heart language. Do they have a loss or a gain here? Is that correct?
I think so. I mean, it's the first thing I'd want to do. And you don't have to be exact. You know, you can estimate. In fact, you want to anticipate the maximum building coverage that you're going to get and offset it with what your best estimate of what your cost basis is. Everybody, I mean, I lost all my records on my purchase. You know, you can go find things at title companies, but I don't have anything from pouring my concrete patio, right? So I've got to just come up with a number, which is fine, by the way. But anyway, so you know, we can't think about, oh, isn't this not taxable? We need to figure out if we've had a gain first.
Right. Okay.
Yeah.
So in trying to get to the cost basis, obviously people have to go back and figure out what they spent on improvements, right? Like you were just saying, remodels or repairs, or that sort of thing. Are there sources that you have identified? I mean, we identify for people when we're trying to help people do their personal property inventory or even their dwelling loss. We say, okay, you know, if you don't have plans, or if you don't have, you know, you don't have records of when you bought things or where you bought things, and you know, you have to get creative, right? We talk about, you know, going to the assessor's office, going to friends and asking if they have photos. Is there a source that you have used or clients have used, other than, say, credit card statements, to try to reconstruct the money that they put into their house for accounting?
I mean, if you have a contractor friend, you know, that would be the best, because they could then maybe they've been in your house and maybe they knew you did the kitchen remodel, and they knew what kind of appliances you put in and such. The other thing is the IRS does have lists related to, let's say, Schedule E and things like that, where they have kind of a list of things you might do to your rental property, for instance, you know, like a deck or fence or landscaping or whatever. So you know, there's a couple of ways to go after that.
Well, in terms of like official records that the state would keep, is there a source that you can recommend that people go to?
Well, if you ever tried to permit that, if you permitted that project, you likely have plans and things like that out there. And maybe your contractor, you know, if they're still around, they might actually have it. But again, I think you're playing sleuth, kind of like you're talking about. You're just using your brain and trying to figure out, well, where can I get this? You know, is there any third party?
Right.
And unfortunately, in some cases, though, if someone had refinanced over the years, usually a refinance will also recapture some kind of changes in property value that may have gone hand in hand with some portion of a rebuild or a remodel. It just depends on the timing of a refinance.
Yeah. I mean, you could have used all the proceeds on a remodel.
Right. Okay. Should the basis of the land be calculated by backtracking it to the year the house was bought?
Yes.
Okay, good. Nice short answer. Okay. I owned the house for 30 years. It became a rental property 8 years ago. Is my cost basis the money I paid for the property, or is the cost basis the fair market value of that property when I started renting it out?
That's a fair market value when you purchased it, and if you took depreciation, you've got a little bit more difficult road. You know, you could have recovered some of the cost of that property.
Okay.
But a CPA or tax preparer would be able to handle that.
Okay. I lived in my mom's home that burned, and I didn't take any of the content money because she's so dramatically underinsured. Should I look into amending my 2017 income taxes? So
I don't quite understand. Yeah,
let's try to unpack this. I lived in my mom's home that burned. I didn't take any of the contents money. So that means the person who's asking the question had a contents loss, right?
Right.
It was not.
And no proceeds. I mean, they weren't insured, it sounds like.
So
right?
Okay. Should I look into amending my income taxes? So she's saying that she had a loss. She wasn't insured. Therefore, can she amend her tax return to offset what she paid in taxes for that loss of unreimbursed contents?
If indeed she did, if indeed she had a loss and she wasn't insured, again, remember, you can't have a casualty loss without an insurance claim.
Can you restate?
So her property was covered underneath her mom's, you know, whoever this was, her mom's personal property coverage.
Okay.
Yeah.
So, okay, I'm sorry, I need you to go over this again. So wouldn't this be the same as somebody who had no insurance on their stuff and their stuff was destroyed? That's not a loss for income tax purposes?
Doesn't feel like it, because you're not able to file a claim.
how does the claim interface with the tax obligation? I'm not sure I get that.
As I understand it, you need to file a claim against insurance, right? If you have it, right, to take a loss.
Okay.
If you're not covered, yeah, but I'm talking about your question,
Okay.
and that is her property was covered by the person's coverage,
Okay.
and probably wasn't a loss, and she probably
Right.
deserves some of the proceeds.
Right, I get it. I
Yeah.
see what you're saying.
Yeah.
You're saying because she theoretically would have to go after her mom to get the money
Yes,
back.
that.
I gotcha.
Yes. Yeah.
Okay. We were days away from moving in, but 95% of our personal property was in the house. We only had $10,000 in coverage for personal property. We have an inventory that's well over $150,000. Is it worth filing for the part of our loss not covered by our personal property insurance?
Okay, so I'm gonna ask a question on that question. Is that 150,000 at fair market value replacement? And if it is, then that's not pertinent to the tax question. What was your cost basis in that property?
Okay.
Yeah. Now, and it could be 100,000, it could be 80,000, and whether you want to file it or not. Yeah, I mean, if it's, if you're going to get more back than it would cost to pay your tax repair, then the answer is probably yes.
Okay. And just to remind our listeners that involuntary conversion is just a fancy lawyer language for your house was basically taken out from under you and sold, not through anything you did. And that's why we use that language. Okay. Let's see. What is a 4684?
That's the casualty loss form.
Okay. That's the IRS form. And as you said, you can only use that if in combination with the insurance claim that you file. In other words, you have to have filed an insurance claim in order to file a 4684. Is that right?
Sorry. I probably mixed things up answering that question. If you have coverage, you need to file a claim. If you don't have coverage, you may be able to claim a loss.
I got you. Okay.
Yeah.
All right.
Yeah.
Okay. If you owned a rental property which was almost paid off, insurance paid money in 2018. When I do 4684, it leads to a huge capital gain in taxes. Is that correct?
Maybe. Again, it goes back to quote unquote, selling your house, involuntarily converting your house. Were the insurance proceeds in excess of your basis?
Okay.
Were the insurance proceeds in excess of what you paid or invested in your home or rental?
Okay, and here she is asking, I'm reconstructing and the house will be ready in mid-2019. Is there a way to offset these gains toward reconstruction?
Well, if you're going to reinvest or rebuild your loss, think about this. Insurance isn't per se there to get you rich, right? It's really to make you whole. If you come out of this without any money from the proceeds, in other words, you've invested all your proceeds back into a new property or rebuilding your property, you likely don't have a gain. Does that make any sense?
Yes.
You've taken what they've given you. You had a house, it turned into cash, you take the cash, turn it into a house, and you don't have any leftover. You're probably okay. And by the way, that's not considering the $250,000 or $500,000 exclusion, right? So there's a lot of scenarios where you don't have a gain. But if you just use that little simple thing, if I reinvest all my insurance proceeds, you will not have a problem as long as you do it within the 4 years allotted to you.
Okay. Can this slide that I just put up, can we use this to illustrate?
Yeah, sure.
Okay. Walk us through this as an example of a gain on an involuntary conversion of a personal residence.
Okay. So yeah, let's say the home was purchased quite some time ago for $150,000. And we mention here the $50,000 allocated to land, but because this is a principal residence calculation, we're actually not going to use it where you would use it if it was a casualty loss calc. There were $25,000 of improvements made since the home was purchased. The home was completely destroyed, and instead of rebuilding, the taxpayer purchased a new home. So total insurance proceeds on the building only, $800,000, and you can see the $175,000 worth of basis is the $150,000 purchase plus the $25,000 in improvements. This results in a realized gain of $625,000. The realized gain is a term of art. Realized does not mean recognized. Okay, this is just realized. Okay, so our insurance proceeds, though, when we lived in the house 2 out of the last 5 years, and we're married, so we can take $500,000 of that $800,000 right off the top, and our proceeds go down to $300,000.
The $500,000 is what a married filing jointly couple can deduct, correct?
If they use this place as their principal residence 2 out of the last 5 years.
Okay. All right. And okay.
You want to skip forward?
No. Well, sure. Okay.
Sure. So our proceeds are now 300. 800 less the 500. Our proceeds are now 300. Our basis at home, again, 150 plus 25, right? 175. Results in a realized gain now of 125 in this conversion. So far, so good.
Yeah.
Proceeds realized on the involuntary conversion, again, 300,000. We're going to buy a new home for 275. Remember when I said if we invested all of our proceeds, we'd be fine? If we invested $300,000 here, we would have no gain.
Right.
But we're only going to invest 275. That results in a $25,000 gain. So of the 125 realized, we're going to recognize 25, defer 100. And all that does is affect the basis in our new home. So we bought it for 275, deferring 100,000, and in other words, not recognizing 100,000. Now our basis in the new home is 175, which, by the way, in a roundabout way, is the basis in our old home. And I remember Eileen mentioning that carryover basis. This is the concept she was talking about.
Okay. So, so Eileen, since we are running out of time here, and I think I'm certainly up for doing a follow-up to this if we get a number of other questions. How about just leaving us with a few kind of nuggets of wisdom from a financial planner standpoint in terms of the things we've discussed today and people's decisions if they haven't made one yet as to whether they're going to rebuild or buy a replacement home or try to cash out?
I think it really is important to make sure that you go slow. Everyone is gradually going to be receiving insurance proceeds. Don't immediately run and make a major decision. We've discussed on other events, you can put those proceeds in an FDIC bank account. You should easily be receiving 1 or 2%. Go slow. Bring in your team of professionals. Take these kinds of slides and put your own figures right next to what Mike just presented, or bring this information to your tax professional and a CFP. There are so many decisions that you're about to make off of this. My takeaway really is, for those of us up in Northern California with Sonoma County, 2 years later, we're still having just people starting to reach this point. And I know folks are here from Los Angeles and Paradise area. Don't rush these decisions. Most likely, you may not have an out-of-pocket taxable loss, so you want to understand what your proceeds really are and use them to best make an informed decision towards renting, buying, or rebuilding. And it really is a chance to just pause for a moment and ask, where would you prefer to be? And then let someone professionally, a tax professional like Mike, back into what truly is available to you out of pocket to make that decision. But go slow. No matter what, that is my feedback. Please go slow.
Well, I'm right with you. Mike, any closing thoughts?
No, I'd echo what Eileen said. There's no reason you need to file by 4/15. Don't check the box. It's you've got time. Don't feel like you have to file at 4/15.
Okay. Well, I really want to appreciate both of your time. Again, just so grateful. And for those of you who tuned in, didn't get your questions answered, or still have more, you can send questions to info@uphelp.org. We will do our best to get you answers. And again, this is not the only educational workshop that we've offered. We have many others that are available for you to watch on our website, but this was a good one. So thank you so much, Mike. Thank you so much, Eileen, Carol, and Winter for putting it together. All the donors who make it possible for us to bring free guidance to your communities. We're rooting for you, and thank you so much. Good night.